Hello and welcome back to the Realonomics channel. In a previous video I used the game of Monopoly as an analogy for how we introduce money into the economy. And in my last video we ran through a thought experiment where a bunch of us moved to a deserted island to set up a new economy from scratch. Now, not all of you are convinced by those arguments. But what about real world examples, Kareem? Some of you say. Well, okay, I've got one for you today. In 1977, the Journal of Money, Credit and Banking published a paper titled Monetary Theory and the Great Capitol Hill Babysitting Co-op Crisis. Try saying that one quickly after you've had a few drinks. Now, the paper was written by Joan and Richard Sweeney, and they got together with about 150 other couples, mostly Congressional staff, to form a club to save on babysitting costs. The challenge that the co-op faced was to ensure that you didn't get free riders, that everybody would give as much in babysitting services to the co-op as they received from it. So the system they came up with was a voucher system where each couple was given 20 vouchers worth half an hour of babysitting time. And so couples could spend vouchers when they wanted to go out, and they could look after other people's children when they wanted to earn more vouchers. But problems began to arise when some couples would save some vouchers to cover unforeseens. And this resulted in a degree of scarcity of the vouchers. And it became a little bit more difficult to earn vouchers back when you needed them. And this scarcity made the couples more reluctant to spend the vouchers that they had. Well, if they didn't spend the vouchers that they had, then other couples couldn't earn more vouchers when they needed them. And so pretty quickly this thing escalated and the whole babysitting co-op ground to a halt. The economic activity in this co-op stopped dead. Now, the solution that they came up with was fairly simple. The co-op printed up more vouchers and distributed them to all the couples. And so this allowed couples to keep some in a drawer to cover unforeseens, but also to have a load ready to spend whenever they wanted them. And so the babysitting co-op sprang back to life and everything ran fine. What do we learn from this story then? Well, the first lesson is that my spending is your income and your spending is my income. And we all have to spend our money and keep the money circulating in order for the economy to work. Savings, however, take money out of circulation. In this case, it was literally vouchers getting stashed in drawers and not being spent back into the economy. And so unless an economy can find a way to recycle savings back into circulation, or it introduces enough money to permit both spending to occur and some money to be taken out of circulation for savings, then this affects output. Thirdly, inflation is often described as being too much money chasing too few goods and services, and this location between too much money and too few goods and services, that dislocation ends up in prices. Well, it seems that this doesn't work the same way in reverse, because in theory you might think that too little money chasing an amount of goods and services would reduce in falling prices, but that's not what happened. Output fell, not prices. Now, there might be circumstances particular to this babysitting co-op that stopped prices falling. For instance, the value of a voucher was set at 1/2 hour, and it would have been seen as distasteful to start changing the value of the vouchers. But for whatever reason, prices didn't fall, output did. The fourth lesson from this is that savings represent a completely different pool of money to spending. As I said, in this case, it was literally vouchers were sitting in drawers while other vouchers were being spent. If you think about this in terms of money, let's take your salary that you receive at the end of the month, for example. Part of your salary gets funneled off into your pension fund, and that money that's sitting in your pension fund will be used to invest in financial assets in the financial markets. The rest of your salary goes into your current account, and that money will be sitting in the bank ready for you to spend on goods and services as you choose. These are two completely different pools of money that get used for different purposes. So you have to think of them in different ways. The assumption that economists have that spending power is spending power and that it doesn't matter who holds the money is wrong. Savers and borrowers have opposite behaviours. A saver is someone who by definition had some money that they did not spend on goods and services. Instead, they put it into a savings vehicle, and that money usually ends up in financial markets being spent on financial assets. A borrower is somebody who borrowed money that they didn't have, or borrowed more money than they had, so that they could spend it on goods and services. So when it comes to the effect on GDP, the effect of savers and borrowers is completely opposite. And yet, famous economists like Paul Krugman and Ben Bernanke would argue that, no, spending power is spending power. It doesn't matter who has it. It has the same effect on GDP. Complete nonsense. The fifth lesson of this story is that it's a very neat demonstration of quantitative easing. What we had was a system in which there were still lots of couples who wanted to purchase babysitting services, and there were still more couples who were willing to offer those babysitting services. But because of a shortage of money supply, the system just froze up. It just crashed, a bit like a computer running Windows XP. Thanks for that, Microsoft. And what happened in the babysitting co-op was effectively quantitative easing. Somebody introduced more money into the system so that the system could free itself up again. And finally, we can also understand what the babysitting co-op would have to do in order to be able to accommodate growth. For example, if another couple joined the babysitting co-op, you would have to print more vouchers and give them some extra vouchers. Otherwise, as more couples joined the co-op, you would have more and more couples wanting more and more babysitting services, but you'd have the same amount of money, and so you'd end up in the same situation. Too little money chasing too many goods and services, and again you would have this scarcity would arise, and you would get the fall in economic activity. So growth in the co-op would require growth in the money supply. So again, this is the exact opposite of what economics teaches. One final thought. We can pretty easily understand in this example the effect of allowing the co-op to lend the vouchers to the couples instead of giving them out for free. If the co-op lent vouchers to the couples and then those couples had to give the vouchers back to the co-op at some point, pretty quickly there'd be no vouchers to circulate in the babysitting economy, and activity would grind to a halt again. When we look at a simple economy like the babysitting co-op, we see that allowing the co-op to lend the vouchers into existence instead of giving them out for free would be absolutely fatal to the co-op. And yet that's exactly how we've designed our money system in the real world. We allow banks to create all of our money as debt. And yes, it is that destabilizing for the real economy. We should probably consider a completely different system. Thanks very much for listening. That's it for today, folks. If you like what you're hearing on the Realonomics channel, then please do consider giving the video a like and a subscribe, and I look forward to seeing you again in future videos. Thanks very much. Bye-bye.